The eighth type of accounting principle is the verifiable evidence principle. As the name suggests, this principle lays stress on maintaining a proper record in the books of account. Every transaction must be supported by proper documents. Documents which acts as an evidence, a proof which can be verified. So, this principle tells us that the accounting records the accounting records should be verifiable and it should be supported by business documents. This principle tells us that all the accounting transactions all the accounting transactions should be supported by proper documents like bills, voucher, invoices, correspondence letters, etc. as evidence. These documents provide a base. These documents provide a base for making entries in the books of account and they also help us for further verification. This concept enables the trader or businessman to keep proper books for quick or ready reference. So, the verifiable evidence principle tells us that all the transactions that takes place in the business must be backed up by proper documents. When goods are sold or purchased, then we should keep a record of the invoices. When cash is paid or receipt, we should maintain proper receipts. While dealing with other businessmen, we should probably maintain proper correspondence letters. These documents acts as an evidence in future also in cases of disputes, and they are also helpful when we maintain our books of accounts, because it is very difficult to remember all the transactions. So These documents helps us to maintain proper books and accounts, and it also helps us to to provide a reference of all the transactions in the future. Ninth and last type of accounting principle is the consistency concept. This concept implies that the same accounting principles or methods and policies, practices should be used for preparing the financial statements. Year after year. In other words, there should not be a change in these policies and practices and methods and principles from year to year, or from one year to another. As the name suggests, this principle suggests that the businessman should be consistent in his accounting practices. The principles that he is following, the method he is following for preparing his accounts, the policy he is adopting for his business should be consistent and should not be changed very frequently and from year to year. If they are changed, very frequently or every year, the results one year cannot be compared to the with that of the other year. If the policies, principles and methods are changed again and again, it will be difficult to assess our the performance of the business, because the result of one year cannot be compared to the results of the other years. For example, if one particular method of depreciation is adopted for a particular fixed asset, the same method should be followed for that particular asset year after year. If method of charging depreciation on a particular asset is changed very frequently, it will become difficult to assess or calculate the exact depreciated value of that particular asset. However, consistency does not prohibit change in accounting policies. The accounting practices and the methods can be changed if required, but any change in the policy should be fully disclosed in the financial statements. So the consistency concepts focuses on the maintaining of a consistent use of same accounting principles, practices, methods year after year. This will help in the proper maintaining of books of accounts. It will help in proper assessment of financial results, comparison of financial results, and it will be easier for the others to understand the our books of accounts if there is a consistency. But this does not mean that there is a prohibition in regarding there is a provision regarding change of policies and methods. If a businessman feels that it is required to change the policies and methods, he can do so. But if he is doing so, it should be clearly mentioned in the books of accounts so that there is no confusion among our investors and our creditors and our customers. This concept also eliminates personal bias because the accountants have to follow a consistent rule, same practices and principle year after year. There cannot be any personal bias. There are chances of less fraud, and because the accountant has a fixed set of rules, practice principles which he has to use year after year. And the most important thing is when the same accounting principles are same accounting, there is consistency in use of accounting principles and methods. It becomes easy for us for periodic comparison of our financial statements. Frequent change in accounting treatment will make the financial statements or accounts or books of accounts unreliable to the users, to the customers, to the investors, and there will be confusion in their minds, and our books of accounts will become unreliable.